Look at what's happening right now in the gold market. While most investors are watching the daily price fluctuations, something far more significant is unfolding beneath the surface. The technical charts are painting a picture that very few people are paying attention to, and it's pointing to a target that seems almost unbelievable: $5,500 per ounce. Let me show you exactly what I'm seeing, because this isn't speculation. This is what the data is telling us when we connect all the dots. Right now, gold is trading in a range that most analysts consider elevated. But here's what they're missing. When you overlay the current price action with historical bull market patterns, we're not at the end of this move. We're barely past the beginning. The technical structure forming right now mirrors almost perfectly what we saw in the lead-up to previous major breakouts, except this time, the fundamental backdrop is exponentially more powerful. Let's start with the chart itself. Gold has been building what technical analysts call a massive cup and handle pattern over the past several years. This is one of the most reliable bullish continuation patterns in technical analysis. The cup formed between the 2020 highs and the consolidation period that followed. Now we're in the handle, that final consolidation before the breakout that typically leads to a measured move equal to the depth of the cup. When you measure that pattern, the mathematics point to a target range between $5,200 and $5,600. But that's just the beginning of the story. The weekly charts show something even more compelling. We're seeing a golden cross formation on multiple time frames, where shorter-term moving averages are crossing above longer-term ones. This isn't just happening on the daily charts, it's confirming on weekly and monthly time frames, which historically has preceded the most significant moves in gold's history. Think back to 2001. Gold was trading around $250 per ounce. The technical setup looked similar to what we're seeing now. Multiple moving averages were aligning, momentum indicators were turning positive, and the metal was breaking out of a two-decade consolidation. What happened next? Gold went on a 10-year run that took it from $250 to over $1,900. That's more than a 600% gain. But here's what makes the current setup even more powerful. In 2001, we didn't have central banks buying gold at record levels. We didn't have BRICS nations actively working to create an alternative to the dollar-based system. We didn't have the kind of debt levels we're seeing now across developed economies. The fundamental drivers today are orders of magnitude stronger than they were at the start of that historic bull run. Now let's talk about what's happening with institutional positioning. The commitment of traders reports, which show us how different market participants are positioned, reveal something fascinating. Commercial traders, the smart money who typically get the big moves right, have been steadily reducing their short positions in gold. Meanwhile, large speculators haven't yet piled in with the kind of enthusiasm we typically see at major tops. This tells us something critical. The big money knows something is coming, but the retail crowd hasn't caught on yet. That's exactly the kind of setup that precedes explosive moves higher. Here's a story that illustrates what's really happening. There's a major European bank, one of the oldest and most conservative institutions in the world. For decades, they maintained a relatively modest gold allocation in their reserves. Last year, they quietly doubled their physical gold holdings, not gold ETFs, not gold futures, physical metal stored in their own vaults. When I spoke with someone familiar with their thinking, they told me something revealing. The bank's risk committee had run scenarios on currency debasement, and their models showed that in every scenario where major central banks continued their current policies, gold needed to be substantially higher to maintain its historical relationship with money supply growth. Their internal target? North of $5,000 per ounce within the next few years. And they're not alone. Central banks globally added over 1,000 tons of gold to their reserves recently, marking one of the strongest periods of official sector buying in history. These aren't speculative traders making short-term bets. These are institutions with 100-year time horizons, and they're accumulating physical gold at a pace we haven't seen since the 1970s. Let me put that in perspective. When central banks were buying heavily in the 1970s, gold went from $35 per ounce to $850. That's a 24-fold increase. Now, I'm not suggesting we'll see that kind of percentage gain from current levels, but the principle is the same. When the institutions that create money start hoarding gold, they're telling you something about the future value of that money. The technical charts are confirming what the fundamentals are screaming. Look at the Fibonacci extensions from the 2015 lows to the 2020 highs. The 161.8% extension, a key technical level that often acts as a magnet for price, sits right around $5,400. The 200% extension, that's at $5,800. These aren't random numbers. They're mathematical relationships that markets tend to respect with uncanny accuracy. But here's where it gets really interesting. The gold-to-money supply ratio is telling us that gold is actually undervalued at current levels. If you adjust gold's price for the expansion in global money supply since 2000, gold should already be trading above $4,500 just to maintain its historical relationship. And that's before accounting for the additional trillions in monetary expansion that's likely coming. Think about what happened during the 2008 financial crisis. The Federal Reserve's balance sheet was under $1 trillion. Today, it's over $7 trillion even after some reduction. The European Central Bank, the Bank of Japan, the People's Bank of China, they've all expanded their balance sheets by multiples. All that newly created money has to go somewhere, and increasingly, it's flowing into hard assets like gold. Now, here's something most people don't understand about how gold moves. It doesn't go up in a straight line, it moves in waves, with each wave taking it higher than the last. We saw this in the 1970s. Gold would rally, consolidate, rally higher, consolidate again, each time building energy for the next leg up. The current consolidation we've been seeing? That's not weakness. That's the market building energy for the next major move. The technical indicators are showing us that this energy is reaching a critical point. The relative strength index on the monthly chart is in a position that historically has preceded major breakouts. The MACD, another momentum indicator, is showing positive divergence, meaning the underlying momentum is stronger than the price action suggests. These are the kinds of technical setups that traders dream about. Let me share another story that shows you what's happening on the ground. There's a major gold refinery in Switzerland, one of the largest in the world. They process gold from mines, recycle old jewelry, and create the bars that central banks and institutions buy. Over the past 2 years, they've been running at maximum capacity, working around the clock to meet demand. But here's the interesting part. The demand isn't coming from jewelry manufacturers or industrial users. It's coming from institutional buyers who want physical metal. And they're not just buying standard 400-ounce bars. They're requesting specific serial numbers, specific refiners, because they want to ensure they're getting newly minted metal, not recycled gold that might have complications with provenance. This tells you something about the nature of the demand. These buyers aren't planning to sell anytime soon. They're accumulating for the long term, and they're willing to pay premiums for exactly the metal they want. Now let's talk about supply dynamics, because this is where the technical picture gets support from fundamental reality. Global gold mine production has been essentially flat for years. Despite higher prices, despite improved technology, despite massive exploration budgets, the mining industry isn't finding enough new deposits to significantly increase supply. Why does this matter for our $5,500 target? Because when demand is rising and supply is constrained, price has only one direction to go. And the technical charts are showing us that the market is beginning to price in this reality. Look at the gold mining stocks. The GDX, the Major Gold Miners ETF, is showing a technical pattern that typically leads the metal itself. When mining stocks start to outperform gold, it's usually a signal that a major move in the metal is coming. And right now, we're seeing exactly that setup developing. Here's where the retirement angle becomes critical. And this is something you need to understand if you have significant assets in traditional retirement accounts. The technical target of $5,500 isn't just about gold going up. It's about what that price level represents for the purchasing power of your savings. If gold reaches $5,500, it's not because gold became more valuable. It's because the dollars you're holding became less valuable. That's the key insight most people miss. Gold doesn't really go up or down. It just sits there being gold. What changes is the value of the currency you're measuring it in. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, and why the technical setup we're seeing makes this particularly relevant right now. Worth checking out if that's your situation. Back to the charts. The weekly gold chart is showing us something that technical analysts call a measured move setup. This is when a market breaks out of a consolidation pattern, and the size of that consolidation gives you a mathematical target for where the next move will end. Based on the current consolidation pattern, that measured move points to a range between $5,200 and $5,600. But there's another technical factor that's even more compelling. Gold is forming what's called an ascending triangle pattern on the longer-term charts. This is a bullish continuation pattern where the metal keeps making higher lows while testing the same resistance level. Eventually, when that resistance breaks, the move is typically explosive. The resistance level we're watching? It's been tested multiple times over the past few years. Each test has been met with selling, but each time the selling has been less aggressive. The market is telling us that sellers are running out of ammunition. When that resistance finally breaks, and the technical indicators suggest it will, the move higher could be swift and substantial. Let me give you a historical parallel that shows you how these patterns play out. In 2010, gold was consolidating around $1,200 per ounce. It had been in a bull market for nearly a decade, and many analysts thought it was overvalued. The technical charts, however, were showing a similar ascending triangle pattern. When that pattern broke to the upside in late 2010, gold didn't just drift higher, it exploded. Within months, it had added over $600 per ounce, reaching nearly $1,900. That's a 50% gain in less than a year. And it happened because the technical setup was right, and the fundamental drivers were aligned. Today's setup is even more powerful. The ascending triangle is larger, the consolidation has been longer, and the fundamental drivers are stronger. If history is any guide, when this pattern breaks, the move could be even more dramatic than what we saw in 2010 and 2011. Now, let's talk about what's happening in the derivatives market, because this is where the technical picture gets really interesting. The COMEX, where gold futures are traded, has been seeing some unusual activity. Open interest, which measures the total number of outstanding contracts, has been declining even as price has been relatively stable. This is significant because it suggests that leveraged speculators are leaving the market. When the weak hands exit, it sets up the market for a move driven by stronger, more committed buyers. And those buyers, based on the physical market data, are institutions and central banks who want actual metal, not paper contracts. The technical analysis of the futures market shows something else interesting. The backwardation in gold futures, where near-term contracts trade at a premium to longer-dated ones, has been persistent. This is unusual and typically indicates tight physical supply. When physical supply is tight and demand is strong, price tends to move higher to clear the market. Here's a story that illustrates what this means in practice. There's a major commodity trading house, one of the biggest in the world. They trade everything from oil to copper to agricultural products. Last year, they tried to take delivery of a large gold position from the COMEX, not to sell it, but to store it in their own vaults. The process, which should have been routine, took weeks longer than expected. There were delays in sourcing the physical metal, delays in transportation, delays in verification. When they finally got their gold, the premium they paid over the futures price was substantially higher than normal. What does this tell us? The paper market and the physical market are starting to diverge. The technical charts are based on the paper price, but the real action is happening in physical metal. And when those two markets finally converge, the price adjustment could be dramatic. The Elliott wave analysis of gold's price structure is pointing to something similar. For those unfamiliar, Elliott wave is a technical analysis method that looks at market psychology and crowd behavior through price patterns. According to this analysis, gold is in the early stages of a third wave higher, which in Elliott wave theory is typically the strongest and most extended wave. If this analysis is correct, and the wave structure suggests it is, we're not just looking at a move to $5,500. That might just be the first major target in a much larger advance. The full extension of a third wave from current levels could take gold substantially higher, potentially into the $6,000 to $7,000 range over the next several years. But let's stay focused on the $5,500 target, because that's what the most reliable technical indicators are pointing to right now. The Bollinger Bands on the monthly chart are starting to expand, which typically happens at the beginning of major trends. The price is riding the upper band, showing strength, but hasn't yet reached the kind of extreme readings that mark tops. The volume profile analysis shows something equally compelling. There's very little trading volume between current levels and $5,500. In technical terms, this is called a volume gap, and price tends to move quickly through these areas because there's little resistance. It's like a vacuum pulling price higher. Think about what this means practically. If gold starts to break out above current resistance levels, there aren't many sellers waiting between here and $5,500. The market could move through that range relatively quickly, catching most investors off guard. Here's another historical parallel that's worth considering. In 1979, gold was trading around $250 per ounce. The technical charts were showing a breakout from a multi-year consolidation. Most analysts at the time thought gold was expensive at $250. They couldn't imagine it going much higher. Within 12 months, gold had reached $850. That's more than a triple in a single year. What drove that move? a combination of technical factors, monetary policy concerns, and geopolitical uncertainty. Sound familiar? Today, we have all those same factors, but amplified. Monetary policy is more aggressive than it was in the 1970s. Geopolitical uncertainty is arguably higher, and the technical setup is just as compelling, if not more so. The point-and-figure charts, which filter out time and focus purely on price movement, are showing a massive accumulation pattern. This type of pattern typically forms before major advances. The price target from this pattern? Right around $5,400 to $5,600, confirming what we're seeing in other technical indicators. Now, let's talk about what happens when gold reaches these technical targets. History shows us that when gold hits major Fibonacci extensions or measured move targets, it doesn't just stop and reverse. It typically consolidates at those levels, builds energy, and then continues higher. So $5,500 might not be the end of this move. It might just be a waypoint on a much longer journey. But it's the target that the current technical setup is pointing to with the most clarity. The intermarket analysis is supporting this view as well. When you look at gold's relationship with other assets, real interest rates, currency movements, the patterns are all aligning in a way that historically has preceded major moves in the metal. Real interest rates, which are nominal rates minus inflation, are a key driver of gold prices. When real rates are negative, gold tends to perform well because the opportunity cost of holding it is low. Right now, even with higher nominal rates, real rates remain relatively low when you account for actual inflation. The technical charts are showing that gold is beginning to price in a prolonged period of negative real rates. The US dollar index is another key factor. Gold and the dollar typically move inversely. The technical charts of the dollar are showing a potential top forming, with momentum indicators turning negative. If the dollar begins a sustained decline, which the technical setup suggests is possible, gold could move even faster toward our $5,500 target. Here's a story that brings this all together. There's a family office in Asia, managing wealth for one of the region's most successful business dynasties. They've been investing for 3 generations, through wars, currency crises, and market crashes. Their investment philosophy is simple: preserve wealth first, grow it second. 2 years ago, they made a decision that surprised many observers. They shifted 30% of their liquid assets into physical gold. Not gold stocks, not gold ETFs, but actual metal stored in secure vaults. When asked why, their chief investment officer said something revealing. The charts are telling us something important is coming. We've seen this pattern before, in the 1970s, in the early 2000s. When you see it, you act. That family office isn't trying to trade gold for a quick profit. They're positioning for a fundamental shift in the monetary system, and the technical charts are confirming their thesis. The seasonal patterns in gold are also worth noting. Gold tends to perform well in certain months, particularly in the fall and winter. We're entering a period that historically has been favorable for the metal. Combined with the technical setup we're seeing, this seasonal tendency could provide additional fuel for a move toward our target. The commitment of traders' data is showing us that commercial hedgers, who are typically on the right side of major moves, have reduced their short positions to levels we haven't seen in years. This is significant because these are the market participants who have the best information about supply and demand fundamentals. When they're less bearish, it's usually a sign that higher prices are coming. Let me share one more technical factor that's particularly compelling: the gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been declining from extreme levels. This ratio tends to fall during precious metals, bull markets, as silver outperforms gold. The fact that it's declining now suggests we're in the early stages of a broader precious metals advance, with gold leading the way toward our $5,500 target. The technical analysis of gold mining stocks is providing additional confirmation. When you look at the ratio of mining stocks to gold itself, it's been rising, suggesting that the market is anticipating higher gold prices. Mining stocks are leveraged plays on gold, and they typically lead the metal at major turning points. The fact that they're showing strength now is another piece of evidence supporting the $5,500 target. Here's what all of this means for you. The technical charts are painting a clear picture. Multiple indicators, across multiple time frames, are pointing to the same conclusion. Gold is in the early stages of a major advance that could take it to $5,500 or higher. This isn't about speculation or hoping for the best. This is about reading what the market is telling us through price action, volume, and technical patterns. And right now, the message is clear. The institutions know this. The central banks know this. The smart money is positioning for this. The question is, are you? The technical setup we're seeing doesn't come around often. When it does, it typically precedes the kind of moves that define investment careers. The move from $250 to $850 in the 1970s. The move from $250 to $1,900 in the 2000s. We could be at the beginning of the next major chapter in gold's story, and the charts are telling us that $5,500 is where this chapter is heading. Not because of hope or speculation, but because of mathematical relationships, historical patterns, and technical indicators that have proven reliable over decades of market history. The question isn't whether gold will reach $5,500. Based on the technical analysis, that move looks increasingly likely. The question is whether you'll be positioned for it when it happens, because when these technical patterns play out, they tend to move faster than most people expect, and by the time it's obvious to everyone, the easy money has already been made. The charts don't lie. They're showing us what's coming. The only question is whether we're paying attention.